Hello, everybody. Here we go for another one of these Substack videos. Hope everybody's having a great day. As usual, no trade calls, recommendations, and responsible loan stuff. We're here for educational purpose only. So I just thought we'd take a little bit of a look at Apple here at quite interesting technical levels. There's a few things to discuss here. Now, right now, you see it's respecting the standard deviation channel quite nicely. And you've got basically mid-channel lining up with the 10-day, the 50-day, the bottom end of the channel lining up with a 100-day with a 200-day moving average. So I'm actually going to clear some of these moving averages just to make the chart a little bit less cluttered because anyways, you know, the locations are the same. I'm just going to leave the 200 DMA. So what's interesting here is, again, we've been using this this channel. It's been a nice upside rotation, very technical, which is also in line with fibs. And what you're seeing here is that we're stalling. We'd initially stalled back in at the beginning of June at this 123 extension target, and we got a little bit of a pullback, respected the channel, respected the 200 DMA, and here it's trying to press higher, and we're getting a failure here. Now, what's interesting with these kind of locations, not only because of what the rest of the market is doing here with a little bit of heavy flows going through, is that these kind of setups give you an awful lot of asymmetry, right? Because even if we're going to continue higher, you know, if we're going to continue to behave in kind of like a healthy manner and respect this channel, this is an interesting place to look for a little bit of a pullback, even if indeed then we're going to continue to rotate higher. So here, both if you're long or short, you'd probably look at this and think the healthy move is to the downside. And what we've had is we've had, you know, this attempt to press higher, break higher, and failure to attract new hires at new buyers at highs, and a reversal. So what this does is that this candle becomes very, very interesting because, as I said, either you're going to get this channel respected and we continue to move higher. Next target is the 348s, or you know, you could get some kind of news that pushes this aggressively one way or the other. And the way we like to look at this is basically it gives you a symmetry, right? So all you have to do is you're looking at yesterday's action, so you're highlighting this candle, and what that's telling you is right now, if this is, you know, if the sells are here and this is going to hold, and especially with this kind of reversal, you think it's fairly good chance that the market tries to come back and test this at least the 10-day moving average. You can see that that's coming in broadly in line with the mid channel. What that does is that offers you a symmetry on yesterday's close, right? Because what does that mean? That means this move is likely good unless those highs get taken out. So you're looking at about 2% risk. Whereas here, even if the market is just going to come back down into that midpoint, right, you've got about 4%. You know, nice little move, goes to mid channel. Even if this is going to end up higher and this respects the channel, you get a little bit of a bigger move, a pullback back into the 200 DMA. Well, all of a sudden, you know, you've got, for about 2% risk, you've got over 10%, you know, 13% reward. Now, equally, as we said, as most people are going to be looking at this as, well, you know, whether you're long or short, this is the healthy move here would be a little bit of a downside move back to the downside towards mid-channel, towards the bottom end of the channel. If we get some kind of news, whether it's inflation data, war headline, whatever, that rips this higher, well, then there's an extremely good chance that we get a Momo squeeze higher to the upside, and still using that kind of candle on a press above and you know, finding buyers above those highs, you know, above those highs with stops below that candle low. Once again, you're risking about 2%, but if this is going to be that explosive move all the way back into the next target, you're looking at, you know, 7% for 2% risk. So this is a very interesting location. Now, again, all things being equal, you would expect, and again, the market doesn't always behave in a rational way, you'd expect the market to try and pull back a little bit, the healthy move to be at least a move back into mid. Then that's going to be the bull bear line for either an attempt higher again or a move back to the bottom end of the channel. And especially if the market trades heavy, if war headlines stay present, if we get a little bit of a higher inflation print, if crude keeps on moving higher, you get a little bit more de-risking. Well, then, you know, it makes sense that this comes all the way back into the 200 DMA, and it's still holding this bullish rotation. It doesn't turn bearish unless it closes below and invalidates the channel, invalidates the 200 DMA. But equally, what this candle here at high does is that it offers you a lot of asymmetry, because you're going to know very quickly where you're wrong on long and shorts. So it's the kind of setup where you can be, quite aggressive looking for longs or short, and even if you get stopped up on one side, then you could try the other side, and because of the asymmetry, usually you'll be okay. Now, of course, there's always three options. We could go up, we can go down, or we could just continue to chop and catch everybody off guard, but that wouldn't be the base case assumption for now, that we stay stuck in yesterday's range and not move at all. Okay, so wishing everybody an awesome one. Hope this little video was useful. All the best. Talk to you guys soon. Take care. Bye bye.